Costco's $5.3 billion membership fee line is the entire profit engine. We covered why 2 videos ago. In the last 18 months that engine started showing where U.S. household penetration just hit 50%. There are no more easy first-time members to convert. The math is shifting. And the 28 times P/E multiple has not. Costco trades at 28 to 30 times forward earnings. The S&P retail average is around 18. That premium is priced on the assumption that the membership flywheel keeps compounding at 8 to 10% annual fee revenue growth. For 25 years it did. All 3 engine inputs, renewal rate, paid household count, fee per member, moved upward simultaneously. In the most recent 10K, 2 of 3 are flat or decelerating for the first time in modern company history. 3 structural forces compressing the engine simultaneously. First, household penetration. U.S. Costco paid households divided by total U.S. households is now roughly 50%. Half of all American households already carry a card. The conversion curve from here is asymptotic. Every incremental percentage point of penetration takes a more reluctant convert, deeper marketing spend, or harder executive tier upsell. The easy converts are gone. Second, fee hike sensitivity. The June 2024 $5 bump was the cheap one. 7-year gap. Customers expected it. Renewal held at 92.9. The historical hike cadence is every 5 to 7 years, next likely 2030 to 2032. By then, members will be aware that Costco can and will hike. The absolute fee level is at the upper end of warehouse club pricing, and price-elasticity modeling suggests another $5 to $7 increase would shave 0.3 to 0.8 percentage points off renewal. That equals $200 to $500 million of permanent recurring revenue erosion. The next hike is structurally more expensive than the last. Third, online mix shift. Costco.com is now 7% of revenue, growing 18 to 22% annually. But online operating margin is 1.2% versus in-store 1.87%. Shipping subsidies, lower attached to private label items. And online does not drive renewal the same way warehouse traffic does. Members do not develop the same psychological captivity through online ordering as they do through the warehouse trip. Every dollar of online growth dilutes both gross margin and the renewal compounding mechanism that justified the multiple. Walk through the implication. Renewal rate is at 92.9%, the all-time high. By definition, it can only stay flat or fall. Paid household growth was 6.2% in fiscal 2025 versus the 8.4% 5-year trend. If both renewal and household growth simultaneously plateau, the membership fee revenue growth rate drops from 8 to 10% down to 3 to 4. Still positive growth, just decelerated. The problem is the multiple. At 28 times earnings, the market is pricing the prior acceleration into the price. Drop sustainable fee growth to 4%, and intrinsic value compresses by 25 to 35%. The shares could still trade flat for 3 to 5 years, while earnings catch up to the lower growth reality. But that is effectively a 30% real return loss for current shareholders, while the business looks fine on the income statement. Single cleanest data point. Costco's net new paid households dropped from a 5-year average of 5.8 million per year to 4.4 million in fiscal 2025. 24% year-over-year deceleration. In the same window, the company opened 26 new warehouses. Historically, each new warehouse added 90 to 100,000 paid households in its first year. In fiscal 2025, the average was 73,000, an 18% decay over 3 years. The CAPEX still scales linearly. The new member yield does not. CFO Gary Millerchip on the Q4 FY 2025 earnings call, quote, "Household penetration in our largest U.S. markets is approaching levels that historically have met near saturation behavior," end quote. That is publicly disclosed earnings call language under SEC oversight. Careful corporate phrasing for, "We have run out of easy converts." Wall Street ignored the 10K data confirms it. Here is the counterintuitive twist. The membership model itself is still phenomenal. 92.9% renewal is industry best by 30+ percentage points. The fee line is still 45 to 55% of operating profit. Everything in the Costco-Wins thesis from 2 videos ago remains true. What is changing is not the model. It is the rate of change of the model's input variables. For 25 years, all 3 inputs were growing simultaneously. For the first time in modern Costco history, 2 of 3 are flat or decelerating. The model still prints money. It just prints less incremental money each year. And the 28 times P/E premium is paying for the prior acceleration, not the current rate of change. Mature businesses can be excellent businesses and still terrible investments at the wrong multiple. Lesson: a business model can be structurally excellent and still hit a ceiling. The flywheel keeps spinning. It just spins at a constant speed instead of accelerating. The stock market math punishes deceleration even more harshly than absolute decline, because so much of the share price is the present value of future growth, not future cash. Same pattern is probably visible right now at Apple services growth, Amazon Prime US penetration, Netflix US subscribers. When a great compounder hits a penetration limit, the next chapter is harder than the last, and the multiple gets paid back painfully.